China is now trying to replace the U.S. dollar with their currency in global trade.
But some countries have been shifting away from tying their currency to our dollar.
China's on the move. That's why Russia does not feel any pain for the United States.
We are in favor of using the Chinese yuan for settlements between Russia and the countries of Asia, Africa, and Latin America.
China's progress in the globalization of its currency takes a significant leap forward as several Hong Kong stocks are now priced and traded in yuan, alongside the Hong Kong dollar. This move, known as the dual counter model, allows about 24 Chinese companies, including prominent ones like Alibaba and Tencent, to be listed and traded in both yuan and the Hong Kong dollar on the Hong Kong Stock Exchange. Initially targeting overseas investors with yuan holdings, the scheme is expected to expand to include mainland investors through the Hong Kong China Stock Connect link-up in the future. Hong Kong alone holds an estimated 833 billion yuan, $117 billion, in offshore yuan deposits, making it an attractive market for yuan-denominated investments. Fund managers view this development as a reflection of Beijing's ambitions to enhance the global use of the yuan and offer additional opportunities for yuan-denominated investments. By diversifying investment options, China aims to reduce the risk of capital outflows seeking higher yields in other currencies, particularly the US dollar. Ding Wenji, a strategist at China Asset Management Co. China AMC, considers the dual counter model a significant milestone and anticipates its expansion beyond stocks. Ding believes the model will eventually encompass bonds and alternative assets, leading to an increase in overseas asset pools denominated in yuan. China's efforts to promote the use of the yuan extend beyond the dual counter model. The country has been actively engaging in yuan-denominated deals with its trading partners worldwide, ranging from oil purchases in the Middle East to commodities trade with countries like Brazil and Russia. Despite geopolitical challenges such as the invasion of Ukraine, China has maintained strong ties with Moscow. Despite progress, the US dollar remains the dominant global currency, accounting for 42% of global payments, while the yuan's share stands at just 2.29%, up from 1.95% 2 years ago. However, China has recently achieved a significant breakthrough in its efforts to promote yuan usage when Pakistan paid for its first government-to-government import of discounted Russian crude oil in yuan. The internationalization of a currency involves not only its use in trade, but also its presence in investment vehicles. Dong Chen, head of Asia Macroeconomic Research at Pictet Wealth Management, highlights the importance of providing avenues for investors to park their holdings of a currency. For foreign investors holding yuan, buying shares in Hong Kong without venturing into mainland China offers a much more convenient method of investing their currency holding. This latest development in China's currency globalization strategy underscores the country's determination to strengthen the yuan's role in the global financial landscape. By pricing and trading Hong Kong stocks in yuan, China is expanding the currency's reach and diversifying its use beyond domestic borders. This move aligns with China's broader ambitions to reduce its dependence on the US dollar and enhance its economic influence on a global scale. The initiative is part of a series of efforts by China to promote the yuan as an international currency. In recent years, the Chinese government has signed numerous agreements with trading partners worldwide to facilitate yuan-denominated transactions. This includes oil purchases in the Middle East, where China has secured deals with major producers to settle payments in yuan. By fostering trade relationships that bypass the US dollar, China is positioning the yuan as a viable alternative for international transactions. The significance of the dual counter model lies not only in its immediate implications for the Hong Kong stock market, but also in its potential for future expansion. The inclusion of prominent companies like Alibaba and Tencent indicates the growing confidence in the yuan's stability and attractiveness as an investment currency. As the scheme gains traction and proves successful, there is a strong possibility that it will be extended to other financial instruments such as bonds, derivatives, and even alternative assets. This broader scope will contribute to the deepening of yuan-denominated investment options and attract a more diverse range of investors. One of the key drivers behind China's push for currency globalization is to mitigate the risk of capital outflows. By providing alternative avenues for yuan-denominated investments, China aims to retain capital within its borders and reduce the vulnerability of its financial system to external shocks. This strategy aligns with China's long-term goals of achieving financial stability and promoting the yuan as a safe and reliable currency for investors. The internationalization of the yuan also carries geopolitical implications. As the world's second-largest economy, China seeks to assert itself on the global stage and reduce its reliance on the US dollar-dominated financial system. By bolstering the yuan's standing, China gains greater influence in global financial institutions and reduces its vulnerability to external economic pressures. It also enhances its ability to project soft power and foster economic ties with other nations, particularly those participating in its ambitious Belt and Road Initiative. However, the path to full currency internationalization is not without challenges. The US dollar's dominance in global trade and financial markets remains formidable, and the yuan's share of global payments is still relatively small. Achieving widespread acceptance of the yuan requires building trust among international investors, addressing concerns about capital controls, and ensuring the stability of China's financial markets. China's decision to introduce the dual counter model, enabling the pricing and trading of select Hong Kong stocks in yuan, is a significant step in its ongoing efforts to internationalize its currency. By expanding the yuan's usage and providing more investment opportunities, China aims to reduce its reliance on the US dollar, increase its economic influence, and strengthen its financial system. While challenges persist, China's commitment to promoting the yuan as a global currency signals its long-term strategic vision and determination to reshape the international financial order. We've discussed how China's dual counter model is allowing select Hong Kong stocks to be priced and traded in both yuan and the Hong Kong dollar, targeting overseas investors with yuan holdings. This move aims to enhance the yuan's international standing, reduce reliance on the US dollar, and provide new avenues for yuan-denominated investments. But what are your thoughts on this matter? Do you believe China's strategy will successfully promote the yuan as a global currency? Or do you think the US dollar's dominance will remain unchallenged? We want to hear your opinions. Please take a moment to like this video and subscribe to our channel for more thought-provoking discussions on global finance and economics. Don't forget to hit the notification bell so you never miss an update. Thank you again for watching this video.